by holding interest rates steady, the central bank did not surprise the majority of market participants. The consensus view was indeed for a status quo on interest rates. But we all know that demand conditions are extremely weak. Industrial production has been very low for quite some time. The capacity utilization for many of the industrial sectors are going down, and the credit offtake also remains weak. So under these conditions, why did the central bank decide to hold the interest rate steady? The central bank in its policy statement today highlighted 3 issues. Let's talk about them. The number one is the monsoon. It's true that the rain so far have been better than expected. The deficiency is only 6%, which puts the rainfall in the normal zone. But equally important are the months of August and September. And central bank probably wants more information before deciding on further action on interest rates. The second factor is the Federal Reserve action. We all know that Federal Reserve has been preparing the markets for a rate hike for almost 1.5 years now. And this is going to be a big event because it will mean the divergence of monetary policy in the advanced part of the world. Until now, US, Japan, Europe, they've all been following easy monetary policy. Japan and Europe are expected to continue with easy monetary policies, but the US is preparing itself for a rate hike very soon. So when that happens, that's a recipe for volatility in capital flows. India definitely is better prepared, but is not insulated from that. So I think some more clarity on what happens from the Federal Reserve side and the aftermath of that, I think will help in interest rate decisions, because too much volatility can constrain policy making, particularly monetary policy making. The third element which the central bank highlighted was the transmission of interest rates. We have seen central bank cut interest rates by 75 basis points this year. Of that, only 25 to 30 basis points have transmitted into the banking sector. The money markets have reacted well to the central bank actions. The CP/CD rates are down by 75 to 80%, but these can only be accessed by highly rated corporates. The low rated corporates depend heavily on bank credit, and they are the ones who are bearing the brunt of high interest rates. So what does this all hold for the economy? We expect inflation to remain within the 6% zone this year. The central government has demonstrated its ability to control food inflation through proactive measures, and those are likely to continue. And if the rains do not disappoint us completely, we should see inflation within the 6% zone. As far as the growth is concerned, the grind up will be very gradual. There is very little support from the fiscal side. The monetary policy is also constrained to support growth in the economy. And then we also know that there are banks are straddled with bad loans, and their ability to support growth is also limited. So I think in these conditions, we expect GDP growth of around 7.4%, which is only 10 basis points more than what it was last year.